So the reason I wanted to get everyone together and just kind of get a little bit of content together, as well as some perspectives that I respect kind of around both our community as well as the region. I was talking to, one of our team members was talking to a founder here in the last 2 or 3 weeks, and just asking, kind of what do you guys think about, everything that's going on right now in the startup world, with VC, funding likely starting to take a little bit of a different turn, likely, just seeing some of the layoffs and hiring freezes that are starting to happen. What do you think about that? And their response was, what are you talking about? And so I was, the response kind of back to them was, told them a little bit about some of the things that are going on, some of the market reports. And they're like, I had no idea this was going on. And so we're like, okay, we and my team typically kind of looks out and at the world and sort of sees some of the things that are going on, but there may be some founders that just have their nose to the ground, like trying to execute like crazy right now, that haven't gotten a chance to sort of poke their head up a little bit. And so for that reason, that was kind of the instigation of wanting to get some of this together and just sort of see and provide some different perspectives on what's going on there. So, you start to see public markets, and there's definitely some outlooks out there that we may be moving into a general kind of bear market, or the big R word called a recession. Your crystal ball is no better than my crystal ball, which is no better than any of these panelists' crystal balls. So we'll start off with that. But there's definitely some thoughts that the water's going to be a little bit choppy here in the next little bit. So wanted to just provide some perspectives, both from founders who have raised capital sort of in these types of markets, and then also a couple of investors who have gone through this a little bit as well, and want to give them a little bit of time. And really, I want to spend most of my time letting you all ask questions of them and helping provide perspectives on that front. So that's sort of the setup for today. I'm going to go maybe 3 to 5 minutes on just some of my thoughts. I think the last one I spent 10 to 15, and I'm going to cut that down pretty quickly because I know you guys care more about what they have to say than what I have to say. So I'll start off with just the overall summary of, everything did just change in the last 30 to 60 days. If you are a venture-backed startup, things are definitely going to be very different, I think, over the next 6 months than they were in late 2021, early 2022. If you go out on VC Twitter, it's doom and gloom. The world is headed for complete anarchy, and capital markets have completely dried up. I don't know if it's necessarily that, but it's definitely a let's keep our heads up and make sure that we buckle up for a little bit of a different ride over the next 6 months or so. So one of the things that I talk to with founders are, and some of the kind of questions I get are, well, we're early stage tech startups. Public markets going down don't really affect me all that much. Why should they affect me? And so I wanted to provide just a little bit of context around, my perspective of when public markets go down, and you all have seen this with your 401k and just in general, they do have a, kind of a secondary impact to you. Your customers are probably going to have, less net worth, less disposable income, or their customers, their clients are going to have less that they're going to want to spend. That is going to impact you on likely longer sales cycles, likely decreased conversion as they're going through your sales funnels. If you talk about the capital markets, LP, limited partner, or angel balance sheets, their personal net worths likely took a hit over the last 6 months. There's likely some additional fear and risk that they're viewing right now. So they may be less likely and willing to invest, and may want some additional downside protection, or may want some additional or some changed terms, some changed market terms when those things happen. And so the likely result from all of this is y'all are thinking about your own, pathway over the next 6 to 12 months. If you're going out to raise capital, valuations are probably going to be a little bit less lofty than they were in kind of the giant free money exists in 2021. Probably less deals are going to get done. You may need to have more traction to see some of the funding or valuations that maybe you could have previously gotten in 2021. And likely, as you're thinking about your sales pipelines and your sales cycles, they are going to take a little bit of an impact. I don't think the world is completely closed up from a capital markets perspective, but it's going to just be a little bit different and a little bit more difficult. So just wanting to kind of provide a context that prepares you for that a little bit. The feedback that I give to folks, as you're thinking about this, with the little bit of the choppy waters ahead of us, I tell folks if you're going to have a little bit of a difficult access to capital in the next 6 to 12 months, right now, if you're not at 12 months of runway, see if you can get to 12 months of runway or get to profitable default alive. Folks are looking, and you've seen in kind of the layoffs in the world that are going on. Meta and Facebook have done a hiring freeze. Main Street, Carvana, Robinhood have started to do some layoffs. If those folks are doing it, there's a potential likelihood that you should be looking at that and looking at your operating capital and what that looks like there. So just be prepared that these are decisions that you probably want to be thinking about. If you've got existing investors or have an open round right now, look to maybe do a quick top off with your existing investors, or look to, maybe close some rounds pretty quickly so that way you don't get, drag those on for a little bit. Your investors, if you are going to go to market, are probably going to care a little bit more about your profitability or path to profitability. So really be thinking about your unit economics of the business, your path to profitability, and consider those things. So that's sort of the negative components to this. There's a couple of things I did want to say that opportunities are going to exist for you in the next 6 to 12 months. There are layoffs going on in the tech world right now. What does that mean? There's some really phenomenal talent entering the marketplace that you might be able to scoop up if you have open roles that you're looking for right now. Additionally, if
right now, can I interject? It also means
sure.
I need to go change my coffee for wine. I'll be right back.
Fair enough.
How about, or some brandy?
Go straight to the vodka, Tanya.
Yeah, exactly. That's it. That's what I'm interpreting.
That's the way to think about it. But the other thing that I'll say as well, if you can show that you're doing well in these rough waters and these rough capital markets and the rough economic environment, investors are going to notice, and they are going to see some positivity from that maybe wouldn't have been there in the 2021 area. And then we don't like to think about this, but if you're thinking, I was struggling a little bit previously, maybe I'm going to see a little bit of a more choppy waters in front of us. Is there an opportunity for a soft landing or an earlier exit than is expected? If you're familiar with the company called MicroAcquire, it's basically a micro private equity marketplace. They're seeing a lot of companies that are 50,000 in revenue to $1 million to $2 million in revenue, record acquisitions, maybe at less frothy valuations than they would have expected. It's not the $1 billion exit that you wanted, but those things are going on right now, and they're seeing some record growth right now. So all of this to say, it's not doom and gloom. Just again, buckle up. We've got an interesting, 6 to 12 months in front of us. So that's me. That's my thoughts. But you all showed up today because, one, I might have dragged you in here, but also you care more about some of the other folks that I want to make sure that you hear their perspectives. So we have Deborah Gladney with QuickHire, who's who has been willing to give us kind of a founder's perspective. She raised her first round of capital in 2020 when everything was very goofy going on. She just put in or just got an additional round of venture capital late last year, has a board set up, and is starting to enter these waters. So wanted to provide her a perspective, to give her a chance to give a perspective. We also have Jeff Amerine from Northwest Arkansas, runs an entrepreneur support nonprofit called Startup Junkie. But Jeff's involved in pretty much everything startup, from investor, from supporter, from just general cheerleader in Northwest Arkansas. And also wanted to give him a chance to provide you all a perspective from the investors or the VC's point of view as well. So maybe we'll start with Jeff. I wanted to give you maybe 5 minutes or so just to kind of, one, introduce yourself a little bit, Sure. But then as you're talking to founders and startups in your community, maybe folks that are in y'all's portfolio, what are you seeing in the world? What advice are you giving to people? And I'll just kind of let you go for a little bit.
Yeah, that's great. Quinn, thanks. And it's a pleasure to be on with everybody. And just a thumbnail of a background. So 9-time serial tech startup founder. I've spent time in 3 Fortune 500s, and I spent 7 years helping run the intellectual property portfolio for the University of Arkansas. The last 15 years, I've been actively involved both in entrepreneurial support organization, running Startup Junkie and the Conductor, which is in Central Arkansas, but also in running several small funds and angel groups. And we're actually actively raising Cadron Capital Fund 2 as we speak. And so I'll give you some perspectives. And one is, I'm old enough to remember the 1970s. And to me, this feels an awful lot like the late 1970s in terms of inflation, potential for stagnation, et cetera. And out of the late 1970s came some pretty amazing brands like Microsoft, for example, and Apple and others. So it's not all doom and gloom, but a few things. If you're a B2B company right now, you can 100% guarantee that your clients are going to be making some choices about whether or not to cut CapEx, how to think about expenditures, how to think about automation. But there's some paradoxical things going on. They're still paying really high rates for talent. That is still an overheated market. Now, there may be some signs of layoffs, but in a lot of enterprises, the war for talent is still on big time. Now, what that means is they may have some choices to say, rather than hiring, we're going to think about automation. We're going to think about how we can increase the productivity of the folks we have. Partly, they have to do that because they can't get the people they need in the numbers they need. Now, that could quickly change depending upon how bad the situation gets with stagnation and inflation. Consumers are definitely impacted. They are making the transition from nice to have to must have, from buying for want versus need. They're definitely in that need category, buying the stuff that's essential. And there's no way around that with $5 a gallon gasoline. That's impacting a large segment of the population, really including all of us. We're having to make choices about how we spend our discretionary money. Now, from a venture standpoint, this is an interesting time that's not completely different than 2008. The very first fund that we started in 2009. And rather than competing against a super hot public market as an asset class and real estate as an asset class, we had a lot of high net worth people that were looking for an asset class like early stage to get involved with, because at least they could see what was going on and potentially impact the outcome of the business. So for small funds in particular that are going to have active LPs or people that are interested in making investments in businesses that are kind of closely held, that are in the area, I think there's some real opportunities there. And we're seeing that as we're raising today. I would say those are some of the fundamental things that I'm seeing. The basic economics that get away from the froth that we often see in the mythology that comes out of Silicon Valley with ridiculous valuations that don't really make sense to anybody. We're going to see some impact to that. I think that companies that have good sales traction, that have good investor traction, that are growing month over month will clearly have the advantage. And companies that have longer sales cycles and require more capital, I think they're going to be challenged, particularly depending upon what sectors they're in and who they sell to. It's not all bad, but it really depends a lot on where you sit. And I'll kind of leave it there to make sure there's time for Deborah, and we can have some roundtable discussion.
Yeah, and I appreciate the context there. What's interesting, and I kind of hear out in VC Twitter world and other areas, is if you're a founder in the Midwest, you're already knowing how to scrape by with limited funding and lower valuations than what is existing out in New York or in Silicon Valley or something like that. So in this weird way, all of this, all of these things that are, negative things that are going on probably will impact the coast more so than you all, because you've been doing this. This is your normal everyday, hard to get access to capital, hard to go and get frothy valuations. So I agree with your assessment that there's definitely going to be a pullback, but weirdly enough, you all have been doing this for a while. This is nothing new for you. It's just going to be a lot more people that are going to be in the same boat that you are, I think.
Hey, if you guys don't mind interjecting with a question, because
Please.
it's really right along that line. And Jeff, your opinion on this, and Quinn as well. And I'm sorry, Deborah, I won't hold us off too long from getting to you. I wonder, and maybe this is Pollyanna, maybe it's not, whether this actually creates an opportunity for young companies in the middle of the country that haven't gotten valuations all frothed up and that know how to, as you just articulated, Quinn, kind of exist in that realm. Is there something that they can do? But I'm actually even selfishly asking on behalf of NXTUS, is there something that advocate organizations and networking organizations that are out there on behalf of founders can do? Can we use this as an opportunity to pull money to the middle of the country because the companies on the coasts resist those valuations falling and they can get better buys where we are?
Yeah, I'll give you one thought about that. And I'm sure Quinn's got some opinions about it. There has been a trend for about the past 5 years where some of the coastal VCs and private equity firms are looking to the interior because they just can't justify valuations that are 50 or 100 times revenues or valuations that are in the tens to hundreds of millions on pre-revenue companies. That just, sometimes that works, but unicorns are statistical outliers. They're not the norm. And so you want to find businesses with strong work ethic, basic blocking and tackling skills that solve real problems. That leads a lot of these players to realize they can get better deals at more reasonable valuations in the center of the country. I think that trend continues because the expense associated with operating on either coast is not going down. And it won't go down quickly enough, even in the presence of the current level of inflation and layoffs to make a difference. So I think there is an opportunity for us in the heartland to attract some of that money. And more than just Steve Case and Rise of the Rest, it will be other funds that are looking to the interior because there's better deals. I think that's a good observation.
And Jeff, to that point, do you recommend founders just sort of overtly selling that? You know what I mean? Start to use a Midwestern valuation as an asset in their broad discussions with potential. What do you think?
I think it's a good idea. I think it's a good idea. And you always want to find the smartest money you can find. It's going to be the most strategic to your deal. That's going to help open the most doors. And syndicates are great. And sometimes if you can get a good local VC investor, but you can also attract some money from the coast that will open new markets, then outstanding. I mean, the one thing you can't deny is density matters. And the density of activity on the coast is just orders of magnitude higher. And so if you can get one of those groups involved, typically some good things can happen. If you're playing for a future exit or acquisition, they're just going to have more access to potential acquirers and more access to potential partners and whatnot. So yeah, it may be a ripe time for looking at a syndicate that includes some coastal investors.
Yeah, and Mary Beth, what I'd add on top of that is kind of another underlying trend that we've all heard about for probably the last 12 to 18 months. People are moving from San Francisco, from New York to Austin to the Midwest. And so when you look at, founders that are already based here, you can continue and even elevate your talent capability or even find capability that you wouldn't have otherwise. I think that's a justification that we can find talent anywhere we need to and work from anywhere we need to. And that in and of itself, I think, points more broadly and better to Midwest-based companies with Midwest-based talent operational expenses as well. So I view that as almost an underlying driver towards the same conclusion that you reached as well.
Awesome. Should I go ahead and jump in?
Yeah, I'd love that. So Deborah, same for you. I'd love just, 5 minutes. You've had an interesting story for the last 24 months or so. I'd love to hear, you're going through this with, the founder's hat on. What are you hearing? What advice are you being given from stakeholders, investors, board, what does your world look like right now, and what advice would you give to folks that are walking into this as well?
Yeah, that's a really good question. And honestly, I mean, to be honest with you, I was nervous. I was a little bit scared, going for the wine cup myself. Didn't know what I was about to go into. As I've started to have conversations, I think they're very much in line with what Jeff really said. It's really, the businesses who are building and getting traction and doing well are still getting funded. And the ones that aren't, like, I think some of us have probably read that Y Combinator letter, and in there it said something about, like, if you're a startup that is post Series A and pre-market fit, you're probably going to have a little bit of a tough time. And I'm like, how were you even able to raise a Series A and you didn't have product market fit? So those are the things that I think we're going to start seeing going away. But as I've been having conversations with investors, as I've been talking about what we've been doing and how we've moved forward and things like that, I just got a commitment yesterday, so things are still moving forward for businesses who are building. As far as from a founder's perspective, some of the advice that I would have is just starting early and just getting out there. You really don't know what you're going to face until you get out there and face it. And so that's really what has helped me a lot. And, Quinn has been awesome, bouncing off ideas and talking to my board early and getting out there and talking to investors, because I was planning to start the process later. But I'm so glad that I started now. Also, the second thing I would say is, because it's such a weird market and things are changing, is I would encourage you to let the market price you, and not being so quick to throw out a valuation. There's a couple things that can happen. If you throw out a valuation that's too high, it can turn off investors immediately, like we're not aligned in that expectation, or you may also sell yourself short as well. And so, as much as you can, letting the market price you, which is the way it probably should always be, is something that I would encourage you to do. Also, having multiple plans in place is extremely important. So for example, for me, we're going for our seed, but if, let's say, things don't tend to work out as planned, our backup option is we're going to do an insider bridge round. If that doesn't work, I have one of our angels on our cap table that has already said that he would top us off as well. So we have plan A, B, C, probably get a plan D in there as well. And so I would highly recommend that. And, Quinn was absolutely right as far as, raising the amount of capital. I'm actually trying to make sure that we're good for 24 months. If you think about, a recession, how long it lasts, usually about 9 to 15 months or what have you. And so a lot of businesses can win by just simply outlasting their competition. And so making sure that you have the runway that can get you through this time period is really important. And then the last few things I would say is, cast a wide net. I think that's really big as far as what Jeff was talking about, maybe incorporating a syndicate that is on the coast outside of the Midwest, just trying to catch a really wide net will help you as well. And then if you had plans to start 3 months from now, I would throw that in the trash and start now, honestly. Really, like I said, it doesn't hurt to get out there early. Obviously, you want to be prepared. And if you were on the last call, it was really helpful as far as knowing what to have, your data room and all of that information ready to go. So you obviously want to be prepared. And I'm glad that Quinn and team are doing things like that to get us prepared. But do that now. And I would say, get going. But those are the few pointers that I have, and happy to open up for a discussion.
Yeah, and as we pop into the next, really, it's kind of the rest of the presentation. I've got some prepped questions that I think would be helpful for the presenters to answer. But really, if you all have questions, chat them in, pop off mute, do what you want to do. I really want to have the rest of the time be more of a discussion, Q&A back and forth from all of the folks in the room. But I'll I'll maybe start with one question. So I'd be curious, Jeff, on your perspective. We've got some folks that have raised venture capital that are either on the call or will be viewing this later. We have some folks that have never raised venture capital before, but are starting for the first time. So maybe they don't have a board in place. They don't have, immediate funding and existing investors available to them. What advice would you give to someone who is not yet venture backed in the next 6 to 12 months? Is it different than you would give if someone had already had some amount of venture capital funding in? I'm curious on your thoughts.
Yeah, so it's really good. And this is going to sound odd, but a lot of times when I've got the mentoring hat on, even though I've got a portfolio of 90 companies I've invested in through the funds and directly, I'll try to talk people out of it. I'll ask them the questions of, first of all, I'll say the happiest people I know are the people that own 100% of their company and have figured out how to finance growth on the backs of their customers in a favorable way by being able to just get busy selling. So I kind of start from that point of view. And then I also get to the ugly reality that something like 0.6%, way less than 1%, actually raise institutional venture capital. And I also say, once you're on that venture capital treadmill, you're on it and you don't get to decide when you get off. It's a treadmill that you'll have to be on for the duration. And if they get through all that, they'll say, well, why should I do it? I said, well, if you're going to miss a market opportunity by not raising venture capital because you can't go quickly enough, unless you do, then you got to raise. And so the advice I give to people that are contemplating it is figure out every other non-dilutive way you can do it first. And if there is no other way, then go down the road of angel, venture, et cetera, and all that goes along with that. And all the comments about being prepared, having the data room ready, targeting venture capital firms that are going to have a culture that aligns with the culture of your business, talking to their other portfolio companies, doing as much diligence on them as they'll do on you. Those are all things that you need to do. Preparation, understanding what they invest in, not wasting their time by pitching something that's not a fit for their portfolio. All those things are important. But the first rule I typically say is if there is any way at all that you can do this without raising outside VC capital, because once you do, it's like being married. I mean, the divorce could be really ugly. And sometimes the marriage is not as much fun as the courtship. So be really certain you want to go that way.
And based on a lot of statistics that I hear out with folks, sometimes your relationship with your investors may last longer sometimes. So,
that's true here in America, right?
But I mean, I agree with your assessment of alternative. Now, I think, especially over the next 6 to 12 months, those alternative forms of financing, grants, revenue-based financing, inventory financing, you put those out there that are non-dilutive and don't set nearly as lofty of expectations of you and put you on that treadmill. I think a lot of folks are going to start looking at those, and those would be appropriate mechanisms to fund your business. Secondarily to, can you use your customers to fund your business for the next while and then ongoing at that point? I couldn't agree more with you on that one.
Hey, Quinn, could you restate?
Go ahead, Faith.
Yeah, could you restate the variations of non-diluted?
Yeah, so I mean, grants would be an option. Revenue-based financing. If you've heard of kind of Mr. Wonderful, 2% of your revenues as a loan payback until you give some amount back. If you're a product-based business, inventory financing or supply chain financing could be an option for you as well. There's a multitude of different ways from a non-dilutive perspective that I think are very positive options on that front.
Okay, great, thanks.
Yeah, I mean, that's a really good point as far as the options. And especially there's a lot of grants for women out there too. And we've been leveraging that. And, I've contracted a grant writer to kind of help me with that just on an hourly basis. And I mean, just with the first application she submitted, we were a finalist for, and we got money for it. So, I mean, it's definitely really helpful. There's a ton of grants out there for us.
Deborah, I'll have a question for you actually as well. And it stems actually from something that Jeff said. right now, your advice is like, don't raise venture capital, go and operate your business successfully. So Deborah, I'm curious, you've got a board in place right now, even from just an operational perspective, what is your board telling you? What advice are you receiving from some of your stakeholders that maybe isn't, from funding related, but as you enter this, just from an operational perspective, what kind of feedback are you getting?
Yeah, I couldn't agree more with Jeff as far as like, if you can figure out how to do this without venture funding, do it, and by no means am I saying that I'm regretting taking venture funding, because I'm really honored, honestly, because like he said, there's very few that even get the funding. But we also were very lucky that we could be very picky with who ended up on our cap table. And so I think we've had a very positive experience because of that. However, it is like a marriage, and just like with a marriage, you got to balance people's opinions and everyone has kind of like their own opinion of it. So that has been kind of difficult to manage because there are so many different ways or things that you could do, because everybody thinks that you should do something different. So I think that has been a bit of a challenge. However, I think the overall consensus is that everyone is in agreement that that we have to extend our runway, that we don't know what's coming up ahead of us. And our board essentially was like, it could get worse, So like, let's say you top it off and you give yourselves a couple more months and then you go raise, but you could be raising in the middle of the peak of it being bad. So the overall consensus was like, try to get ahead of it if you can, which is why we decided to go for our seed round now and close that round out quick and get ahead of it versus raise our seed round during the peak of it. So that was the overall consensus that we received. And I think also what I'm hearing too is that it is tending to impact more at the growth stage, equity investing quite a bit, as far as like the amount of deals that are being done, just kind of slowing down there. But at the seed, pre-seed, which I think most of us are, deals are getting done, but yes, valuations are being impacted. But we were always kind of that way from the beginning. When we finished Techstars, we had a couple other portfolio cohort companies that, they heard what we were going for, and they're like, that's way too low. But now they're struggling, so I'm honestly grateful that we've always kind of had that mindset. So far it's been okay for us.
If I could, just to follow on what Deborah said there's sometimes this trap where there's a tendency, or has been, to set the valuation too high, particularly on a seed round. Mm-hmm. And what happens is you might be able to get people involved at that higher valuation, but the inevitability is, if things take longer and cost more, and they mostly always take longer and cost more, then you're setting yourself up for either a flat round or a down round. And then everybody is pissed off. The people that invested at too high a valuation, the founders, nobody's happy at that point. So you're much better off to set a reasonable valuation, particularly in a seed round, and outperform. And then you can show that bump up, and it's okay. You maybe have a slightly smaller pie, but part of a much larger pie. Being reasonable in the valuation is an attribute. You waste less time raising the money. You can prove some things. It's always better to underpromise and overdeliver. It's almost always better to have a valuation that's maybe slightly lower than what you could have gotten, because it's just, you're not going to waste as much time trying to convince people, or you're not going to get a bunch of people around the table that really don't understand the business you're in and are willing to take any valuation. So yeah, I applaud the fact that you raised at what you believed to be a reasonable valuation and weren't swayed by other people that were maybe getting more at the time. I think it's a smart move.
100% agreed. And he's not just saying that because he's an investor, for the record, folks.
I've been on all sides of the table.
All right, open questions from the room.
I have one I just would like your thoughts on. So I think with the kind of startup that I'm working on, it actually is benefited by a down market. So quick background, it's a consolidator for buy now, pay later loans. So they're all managed in one place. And you're going to see buy now, pay later lending. It was already going crazy. You add a recession on top of it, and it's going to, it's going to be a tsunami. So I was hearing what you were talking about. I was thinking, well, maybe I need to kind of play up that angle that growth actually aligns with what's happening in the marketplace today. But I wonder if that's kind of too much on the nose. Or people are probably smart enough to figure that out on their own. But I was kind of thinking that maybe that might be one of the ways that I break through the clutter of all of the other people that are sending in decks and seeking an audience with the VC, is to try to show alignment with current economic situation.
I don't think you can go wrong by doing that personally. And
okay.
The thing I love is when you make an assertion, having it backed up by fact. So having the data that says, this is what we're seeing, and this is the way this is going to go. And it's through our own customer discovery and our own primary research. And it's also through these other third-party sources that everybody trusts. So that kind of clarity for economic opportunity is helpful. When you have to kind of ask 100 questions to get to really, why should someone care about this venture? That's when it's tough for a VC investor. So I would be as blunt and as upfront as you can be in communicating why you've got economic opportunity and what those drivers are. I think it's super helpful to do that personally.
Great.
And if I could just chime in, that was really great advice from Jeff. From a founder's perspective, I mean, I kind of went through that last year. So we helped the service industry with talent needs. And so last year with COVID, as they reopened the restaurants, obviously like QuickHire was like the perfect thing because they needed to hire. But, so we obviously leveraged that, but just make sure you also talk about though, like the future though, like where, yes, this is the wind at our backs, but what is going to happen next? Because I think even in our conversations, they asked a lot about, okay, so then what happens after people are fully staffed and they don't need QuickHire anymore? So anyways, as long as you could tell that long-term story, leverage the heck out of it.
Okay.
Yeah. And Deborah, the thing, and Jeff, this comes from what you said, Deborah, you had validation that you had a tailwind. You had growing customer base, growing revenue base, et cetera, from a lot of that. And so your tailwind was really real. And people could very easily see that, I think. Faith, when, going through, I run an angel group. And so I talk to founders looking for capital quite a bit as well. From March 2020 to kind of even close to the end of the year, 90% of every startup that I talked to had a tailwind from COVID. They had a COVID helps me story. And let's be very real about that. 90% of that 90% were not real, right? So the message that I give to you is, if you do really have a tailwind from this, one, show that you can prove it, but then, have that validation in there to support a lot of that. Because if the answer is yes, similar to mid 2020, folks that did have that, you look at Zoom, you look at other areas that really had this massive growth because they were really impacted from it. So back to sort of the opportunities here, there are really big opportunities if you can thread that needle appropriately. So again, bring validation to the table, but then if you can, leverage the hell out of it.
Okay, great. Thank you, guys.
Okay.
Other questions from the room?
Jeff,
I would be interested in,
I'm sorry.
not just a question here, but I would be real interested in looking at your valuation tables. If any of you would be willing to share that, how you've, I've seen some things, and I've got some guidance on it, but I would, if anybody would be willing to share some real life valuation table things, and I would love to off this call, schedule another meeting with you.
When you say valuation table, do you mean just like general benchmarks?
Yeah,
for
general. What are you, you know, what's your volume? What's your sales volume? What's your revenue growth? What's your valuation?
Yeah. And I can, I don't know about, yeah, I don't know about individual ones specifically, but certainly some public data sets or anonymized data sets, probably for sure. And I can look and find some of those and give you those after, Tona.
Okay, great.
I'd love to see it too, if you're sharing.
Hey, this question is probably most for Jeff, but Quinn may have some insight as well. I wondered if there's a hack at all for founders to try to find funds or VC groups that might be paying a little more attention to, you know, Midwest solid and Midwest valued, you know, startups right now. From among, you know, co-investors on recent deals, I mean, is there, you know, would you do 2 or 3 or 5 names occur to you, or 0 names occur to you as, boy, if I were looking for folks on the coast ready to look in the middle of the country now, here's who I'd reach out to? Anybody that's already shown their trend in that direction?
Well, the one real obvious one is Revolution Ventures, which is Steve Case and his crew. I mean, that's kind of the real obvious one. There are kind of interesting firms like RZC Advisors, which is actually not based on the coast, but that's the Tom and Stuart Walton's kind of captive fund. They're looking for great businesses. If you happen to be in sectors that are of interest to them, they tend to have a very long-term view. On the coast, it really depends on the sector you're in and what you're doing. I mean, it's too broad an answer to say these people are specifically looking. There are some that are focused on supply chain. If you happen to be in things that touch supply chain that are coastal, that will look internal, but it really depends on the sector and the tech and kind of what you're doing before I could give you a good answer on that. If I knew more, I might be able to give you some leads.
Yeah, the way that I would think about that is one, for everyone on the call, VCs love telling folks about their portfolio companies. So most of them are very, you know, out in the open about who they've invested in, who they're supporting. So if I was tactically going to go try to find some of those people, I think I shared on the last call, you know, there are, you know, angel and VC databases of where am I located? Where do I invest? Sectors, stage, et cetera. You can sort of slice and dice down to, okay, who's out on the coast? And then really, you know, publicly available information on their websites of, okay, who made their first couple of Midwest or non-coastal investments from that group in the last 12 months? And that you could probably narrow some of that in from that perspective, because I don't have anybody specific off the top of my head.
And this is obviously, I don't have any coastal either, but one observation that I've noticed as I've been going through my process is the South and Southeast has also taken quite a bit of interest in what's going on in the Midwest as well. Just very similar values, similarity in like overlooked regions from a venture capital perspective. And so, you know, a lot of like Atlanta funds have been really intrigued by what's going on in the Midwest as well.
I agree. And to add to that, for about 10 years, we've had relationships with Nora Mosley Partners, Fulcrum Equity Partners, tech operators. There's a handful of really nice, good size funds that have very specific investment thesis that they're looking for in SaaS or in cybersecurity or whatnot. But Atlanta is a good place to mine. And you'll find that it's a different set of people, a different set of values than what you get from folks out of the Valley. And that might be a really good place to look first for people that have good sized funds and have had some excellent success and would have values pretty closely aligned, I would think.
Okay. Good.
I maybe throw a question in here as well. And this is for both Jeff, you and Deborah. So Deborah, I'll say you send out phenomenal monthly stakeholder updates. I'll start with that. If anybody wants to, you know, learn the right way to do it, go talk to Deborah. She does a really good job at them. How, you know, now that things are looking a little bit more different right now, regardless of it's your existing investor base or your board or even just stakeholders that are interested in your stuff that you're sending updates out to, what's your communication style? Has it changed at all? Are you communicating more? Are you communicating less? Are you communicating differently? Do you have any thoughts on that? Deborah, I'd be curious on your thoughts first.
Really good question, because and even outside of the market condition, I feel like it's something that I've had to learn on this side of, now being venture backed, just the communication, and one of the things that I felt like I actually struggled with in the beginning, after taking on venture funding, was almost a little bit too much, to where I was getting too many opinions that were different, and it was making it harder for me to make a decision about my business, and so I think I had to, first of all, I had to get better as far as, what advice I take on, but even just the amount of conversations, if I'm spending so much time having all of these conversations, I'm spending less time building the business. And so I've tried to kind of scale back, and also just, set recurring, there's a few that I have just a few recurring meetings with, but outside of that, it's just my board meetings. And then, obviously as needed. And it's honestly been really helpful. I feel like we've been able to grow more since I've been more like available. And so that has been the biggest thing for me. But I think, to your point, the monthly updates, I honestly didn't realize how valuable they would be until I think the recent one that I just sent out, Quinn, where I was saying that we are preparing for our seed round. I had so many responses and people booking on my calendar right after I sent it out. And I was like, wow, people actually really read these things, and they're very interested in what we're doing. And everyone felt like they had been up to date, and people I hadn't talked to, on the phone in a while, knew where we were at, had been up to date. So I think if you can have a consistent monthly update, it doesn't take a lot. There's a lot of great platforms out there that structure it for you. I use Paper Street. They structure it for you. It doesn't take a lot of your time. It really does help with at least having that consistent communication and not spending too much time taking away from the business.
Quinn is keeping his poker face, but he is cheering you really loudly right now, Deborah.
100%. I agree with everything Deborah said as well. I read all of those monthly updates that come through, and they're succinct. It's typically a page or so of information. It gets right to the heart of the matter, what went right, what went wrong, where we need help. Super, super helpful. And one other observation or comment I'll make is, as a founder, over time, you can feel like you're getting kind of whipsawed back and forth because you've got all these experts that have invested. You probably have mentors and advisors. Founders have to develop a really solid founder filter. Your job as the founder is to synthesize those inputs. The best investors don't expect you to be an order taker. They're going to challenge you with thoughts or whatnot. They want you to take all that in, synthesize it, and then come back to them. One of the folks in my portfolio that has done that exceedingly well, and I've known him since he was a student when I taught new ventures at the university, is a guy named Ryan Frazier that runs Arrived Homes, which also has money in from Jeff Bezos and a lot of folks. He's now based in Seattle, but he is spectacular at taking advice from multiple sources, synthesizing it, and then going back to those people and say, I heard you, but here's what I'm going to do, and here's why. And that, to me, that's great. Now, some investors might not like that. They might expect you to line and verse. The best investors will appreciate that because it's your job to run the business, not theirs, ultimately. So I couldn't agree more with what Deborah said. And it's a skill that you have to learn because it's really intimidating on the front end when you've got all these people that have invested in you and you think you've got to take every bit of their advice. You don't. You just have to be respectful and tell them why you didn't and what you're going to do going forward. So that's really
my general comment to add that I give to folks is when things get bumpy, folks would rather you over communicate as to under communicate. If you have stakeholders that you're working with, partners that you're working with, et cetera, if you are going a few months, and a lot has happened in a either in potentially a a bumpy or negative fashion. Them not being in the loop is probably the worst thing. I always tell folks, make people tell you to stop emailing them. And that's sort of the area that I typically tell folks to get into. So in general. All right, we've got 5 minutes left. Final questions from the room.
I just want to say I applaud founders for being here, candidly. I think, especially when I was starting our business, I didn't, having these type of discussions are so critical, especially in these times and outside of just the market conditions, just trying to build a business, and trying to figure out, you're navigating waters that you've probably never navigated before. And so, just even showing up today, just want to applaud you for it.
Back at you. Thank you for being here. You guys, everybody, and sharing. It is helpful.
Yeah, absolutely. This one and the last one, this is really practical. We can go and apply this immediately. And I definitely appreciate you guys taking the time, and Quinn, getting things organized for us.
Glad to be here. And you're lucky to have somebody like Quinn doing what he does. It's super helpful. And sometimes it can be really thankless work. Most of the people that do it are committed. It's more of a calling than a job for them. So good on you, Quinn.
Appreciate that. Appreciate it. All right, I'll go ahead and stop the recording here.